Hey, this is Todd Miller here with Five Plan Partners. I'm on the Portfolio Strategies team. And this week, I'm here to talk to you on our educational insights about the Fed balance sheet. So we hear a lot about the Fed balance sheet, but there's a lot of misconception of what it actually is. It's pretty simple, actually. Most of their balance sheet is filled up with Treasury Securities, just U.S. Treasury debt, anywhere from about 2 to 10 years and as short as a couple months. After that, they kind of get into the mortgage-backed security space, where deals with mortgages, Fannie Mae, Freddie Mac, typically. Some other assets that they might include would be the repo market and the discount window for other banks. They don't necessarily hold a ton of cash. They do a lot of their work through the liquidity swaps that they do with other banks. Some terms that you might hear used throughout Fed policy regarding their balance sheet would be quantitative easing and quantitative tightening. So quantitative easing typically refers to the Fed taking on a bigger balance sheet. They typically do this when they're lowering rates. Inflation will be in a good spot. They're lowering rates. They're adding to their balance sheet, and then when they want to raise rates, another tool in their ammo would be the quantitative tightening. So that they might be hiking rates, and then they say, "Well, we're gonna reduce our balance sheet." And how do they do that exactly? They go about that by just any bonds that are coming due, like the Treasury Securities. They'll just put a limit on what they allow instead of rebuying, which is what they typically do. They put a limit on what they're going to allow to just hit the market again. They're not going to rebuy this. So maybe they say we're gonna let 10 billion go this month. So as soon as those treasuries come up, they got 10 billion due this month. They're just not going to repurchase them. They're not going to put any more money back into the economy. They're going to try to let inflation, tamper down while they're increasing rates, possibly. If you got any questions, please feel free to call us, email us, get on our website, and then of course you can follow us on all our social medias: Facebook, Twitter, LinkedIn.